Good morning and welcome. I'm Naomi Domingo. It's Monday, April 7th, 2025, and global markets are reeling this morning, pointing towards a turbulent start for Wall Street later today. Let's start with the U.S. economic picture. The latest hard data we have for Q4 2024 showed the economy expanding at a 2.4% annualized rate, driven primarily by consumer spending. However, that feels like ancient history given recent events. The labor market, while still adding jobs, 228,000 in March according to the latest report, saw the unemployment rate tick up slightly to 4.2%. It's still historically low, suggesting underlying resilience, but it bears watching closely. Inflation remains a key focus. The February Consumer Price Index showed headline inflation easing slightly to 2.8% year over year, with core inflation, stripping out volatile food and energy, at 3.1%. While that's movement towards the Fed's 2% target, it's still elevated, and survey data suggests manufacturing input costs were already rising sharply before the latest policy shock. We'll get the March inflation figures later this week, which will be critical. But the overwhelming story dominating sentiment right now is the fallout from the White House's announcement last week of sweeping new tariffs, a 10% baseline on nearly all imports effective last Saturday, and significantly higher reciprocal tariffs targeting specific countries set to kick in this Wednesday, April 9th. China has already retaliated, announcing a steep 34% tariff on U.S. goods. This aggressive shift in trade policy has sent shockwaves through global markets, stoking fears of a trade war, rising inflation, and a potential global economic slowdown, even recession. Economists are scrambling to revise forecasts, with some now seeing a 40-50% chance of a U.S. recession in the next year, citing tariffs as a major headwind that could hamper growth and push inflation higher. The reaction overnight in Asia was brutal. Tokyo's Nikkei 225 plunged 7.8%. Hong Kong's Hang Seng suffered its worst day in decades, closing down over 13%. Mainland China's Shanghai Composite shed over 8%. That negative sentiment has carried directly into the European session. Major indices across the continent opened sharply lower and remain deep in the red. Germany's DAX index plunged as much as 10% at the open and is currently trading down around 7%. France's CAC 40 is off roughly 6%, and London's FTSE 100 is down nearly 5%. There's a palpable sense of anxiety across trading floors. And looking ahead to the U.S. Open in a few hours, well, buckle up. U.S. stock futures are indicating severe losses. Dow futures are currently down over 1,000 points, suggesting a drop of around 3 to 4%. S&P 500 futures are pointing to a similar decline, down around 3%, while NASDAQ futures are indicating an even steeper fall, down over 4%. This follows the historic sell-off late last week that wiped trillions off market values. So, what does this mean? Markets abhor uncertainty, and these tariffs inject a massive dose of it. While free markets generally adapt, such a sudden and broad intervention creates significant friction and risk. We're seeing a classic flight from risk. Equities are selling off sharply, and even assets like crude oil are down over 2.5% on fears of slowing global demand. Bitcoin has also tumbled. Investors will be watching closely for any signs of negotiation or de-escalation between the U.S. and its trading partners. Until there's more clarity, volatility is likely to remain extremely high. Beyond the tariff drama, keep an eye on those upcoming U.S. inflation numbers, the release of the Fed's March meeting minutes midweek, and the start of the Q1 earnings season, with major banks reporting later this week. These could add further layers to an already complex market picture.
Hi, I'm Stu Norcat, and thanks for watching Constructive News. Subscribe to get regular updates about the most important news stories, and we thank you for watching.